There is nothing better than always to be in the know-how. This is what this session is about today. The markets are in turmoil. The markets are acting very irrational, very emotional, based on the sentiments and based on a specific verdict that took place yesterday. And actually, it shouldn't be responding like this. If you really understand and look at the big picture, you would think that the market would actually be responding the right way and in green. However, because it's based on irrationality, emotions, and just sentiments, this is exactly what it's supposed to, this is how it decided to react. Because usually the markets are forward thinking and they don't like surprises. They like to predictable things. And even though it was predictable that the Feds were not going to cut the interest rates, still the markets are reacting negatively towards it. So what are we discussing today? First of all, we're going to identify some few things. Why is the market reacting like this, like we just said? We already understand the reason why, right? The Feds refused to cut rates once more for July. And there were also no positive indications looking forward to September of the Feds cutting rates even further. Let's clarify a few things. The stock market has been hitting all-time highs without interest rate cuts. Even the crypto industry has been, some of the cryptocurrencies have been hitting, even altcoins besides Bitcoin, have been hitting all-time highs without interest rate cuts. And so even real estate have been hitting all-time highs right now. So the markets have been doing great. Even commodities have been hitting all-time highs. Silver, gold, hitting all-time highs. All of this achieved without interest rate cuts. However, what's still been happening in the background is the M2 supply, right? The money supply, the global money supply. That's been going up. So basically that means that what moves the markets is liquidity and not just a cut of the interest rates. Now, let's make this thing clear. Interest rate cuts will result in cheaper access to money, like we've been discussing multiple times, but that's not the topic of today. What we want to cover today is understand that actually, if you look at the big picture and step back, you'll realize that the reason why Jerome Powell is not cutting the interest rates is because all these clarity and regulations that are being passed. And the way, there's two ways to cut interest rates, and there's two outcomes. The first one is what's been always happening through the Feds. And this is what Jerome Powell is avoiding. You cut interest rates, that means cheaper money, cheaper liquidity. However, once you do that, that means that you have to print more fiat, right? And more fiat will be printed into the economy. This will lead to inflation. Inflation will lead to loss of purchasing power, and it will also raise the debt ceiling even further. And that's not what's needed right now. Like we said, assets such as real estate, commodities, stocks, cryptocurrencies are already hitting all-time highs. They are at the all-time highs already. So there is no point to cause inflation. However, on the other side, regulations such as stablecoin bill, the Genius Act has been just passed, and many other regulations are getting ready to be rolled out as well. That will bring demand for both the dollar and the treasuries, the bond markets. And once the dollar is in demand and the treasury bill, the bond market is in demand, with the Genius Act, which is the Stablecoin Act, it will bring demand for the stablecoin, for the bond market, and it will put out stablecoins, the US denominated stablecoins, on a global map, and it will be used on chain. So this will help to bring demand for the bond market. And when there's demand for the bond market, interest rates naturally are brought down without having to mint money, of print money, or cause inflation. And this is why Jerome Powell has been just relaxed and just sitting, and even due to so much pressure, is not budging, because there is no point of causing inflation just by cutting interest rates inorganically. If you can do it organically through the Genius Act stablecoin bill passing, stablecoin issuers such as banks, institutions are getting ready to launch their own stablecoins, and they'll be required to purchase bonds. Once they do that, it will bring a large demand for bonds. That means it will bring the interest rate bond markets, the bond rates will come down naturally, and it will make access to liquidity cheaper without the Feds having to intervene. That's the whole point. But don't take my word for it. Let's go through it step by step and really understand what's happening here. So right now the market is in turmoil. It's volatile right now because the Fed's resistance on rate cuts, right? And the market is now rethinking, right? They're like, okay, what's next? And there was no positive news on September or for the rest of the year, interest rates being cut. And like we just discussed, there is no reason for that, because once the institutions, financial institutions, start issuing their own stable coins, they will be required to purchase bonds. And once they do that, it will bring down the interest rate naturally without having the Feds to intervene. That's the whole point. But let's verify all of that step by step. First of all, let's look at the number one point that is pointing towards stablecoin literally promoting the bond market. First of all, you see this article, stablecoin transactions volume surpasses Visa's in Q1 2025. As we all know, Visa and MasterCard combined have over 90% of the market share in terms of payment processing. So, and stablecoins on chain nearly doubled Visa's volume, over $6 trillion, right? So do we really understand that? This is the last graph over here, right? You see in green is stablecoins, and they're almost doubled Visa's volume, transaction volume, trading volume. And this is massive for such a small niche known as cryptocurrency, blockchain technology. And this is massive because Visa is over 50 years old, has been around for 50 years. Stablecoins have been around for barely 7 or 8 years, right? And already they are doubling transaction volume of Visa. So this is the first indication. And keep in mind, it's happening while the large players like Apple, Meta, Microsoft, JP Morgan, and all of them, they're not even launched their stablecoin on full load yet. And already stablecoins are surpassing. So let's keep that in mind. That's the first aspect. So stablecoin, US denominated stablecoins are going to be in demand and bring demand even more for the bond markets. Once that happens, it will naturally bring interest rates down. That's why Jerome Powell, the chair of the SEC, Security and Exchange Commission, is relaxed and is not in a haste, in a hurry to cut down interest rates, triggering inflation, loss of purchasing power, and also a rising debt. So that's the number one right now. So stablecoins are literally doubled in terms of transaction volume of Visa in Q1 2025 alone. So within the first 3 months of 2025, without it being at its full potential yet. So the best is yet to come. So it might quadruple or 5 times even what Visa is doing within the next coming months as institutions are launching their own stablecoins. So that's the first step. So another thing also that we need to look at here is that it says here company treasury is where it belongs. For many, many years, especially beginning 2024, it's been all about Bitcoin, right? Bitcoin is really straightforward. It's looked at as a store of value. It's the digital gold. and it has the first mover advantage. It's the largest cryptocurrency in terms of market cap, right? And it's the first one that has the largest ETF as well. However, now Wall Street is really starting to understand the value of Ethereum, right? Plus the how the the banning mechanism is a major key player as well, along with yield, right? Because banning keeps this asset that is energy deflationary and scarce, and the yield is what assets always should have, right? You should have a yield as you're holding it. That's why stock dividends are in such high demand, or stocks that pay out dividends, right? So as you're holding something, it pays you out distributions. That's in high demand. This is why also the bond market is in such high demand, right? So as you're waiting for your bonds to mature, you get paid, right? You get paid yields in terms of treasury if you hold treasuries. So now, Wall Street now understands what Ethereum is all about. It's all about wrapping it, and they did that in terms of ETFs, right? It's an ETF wrapper, and then you can stake it, and then you can earn yield with it. So it's really straightforward. And this is something that now Wall Street understands, right? Based on Bitwise CIO. And Bitwise is also one of these digital cryptocurrency digital assets, asset managers, actually, right? So there's another point that also highlights what makes Ethereum such a massive and a solid asset, treasury asset, right? First of all, like we said at the beginning, the most transactions are in stablecoin, and stablecoin predominantly, as we're about to look at, are transacted on Ethereum, and then that will bring demand to a bond market. Treasury bonds or tokenized bonds are also predominantly on Ethereum as well. Now, the staking, the banning, the yield, all that takes place on a proof of stake blockchain. And Ethereum is the largest proof of stake blockchain as well. So what's next? Let's look at what's next here. So another thing that plays a major role is that this week, right, to be specific, on the July 29th, the SEC allowed in-kind redemption and creation for all crypto ETFs. Basically, it's for Ethereum and Bitcoin. So authorized participants are allowed to do an in-kind creation and redemption, right? But only authorized participants. So what is authorized participants? Let's understand that, right? So decision allows authorized participants to create and redeem ETFs shares directly in BTC and ETH. So that means that if you're if you're a company, an authorized participant, and we're about to look at what is an example of an authorized participant. If you have that, and let's just go there right now. An authorized participant. So first of all, in-kind creation and redemption for spot BTC and ETH don't mean individual investors, you and I, can exchange Bitcoin and ETH for ETF shares or vice versa. Creates, redeems are limited to so-called authorized participants, like we said. Who are those? Those are the Goldman Sachs and the JP Morgans. So JP Morgan and Goldman Sachs can now officially, let's go back here, redeem their ETF shares directly into Bitcoin and ETH. This is a major step forward now. This is a major step. So they can go back and forth because their market is over the counter and it's extremely liquid. So they can move back and forth from shares, ETF shares, to the real asset, Ethereum itself or Bitcoin itself. So that's how they keep the liquidity off chain. This is key that we also need to understand. And this was just approved this week. So another thing that we also need to understand is that BlackRock's ETF could soon offer staking, right? because the SEC now moved forward by approving or allowing, or rather acknowledging, BlackRock and Nasdaq's filing to allow Ethereum ETFs to be staked. So this is a major deal, and by far the biggest fund that is tracking ETF is BlackRock, and they have been green lighted, and this is a great move forward that once green lighted and approved will allow BlackRock, which holds the largest fund tracking Ethereum, the largest Ethereum ETF, and Nasdaq itself, will allow ETF holders to stake their ETH. This is a major deal. So what are we looking at so far? First, the largest, let's pull all of this together. Before we do that, let's look at one more thing here. So Fidelity is the third largest, right? The third largest asset manager in the world. And they believe that Ethereum is not only a store of value, but is a medium of exchange as well. So here in blue, as you can see, that the following section will also demonstrate that Ether can serve as a medium of exchange and a store of value. A medium of exchange has so far always been the dollar, right? And the challenge with the dollar is it's inflationary. But now, and you can't stake a dollar. It's not like you can hold the dollar and you earn more dollars. That's not how it works. They're two completely separate things. There's the dollar as the medium of exchange, and then there is a treasury as the store of value. So these are two separate things. The dollar is an asset on its own, traded on the foreign exchange, and then the bond market is an asset class on its own that is also used for governments are using to accumulate liquidity or get funding by offering a specific interest rate to pay back to those who are actually lending their money to them. Now, Ethereum is both of that in one. The third largest asset manager believes that, right? That's the argument. They're saying that Ethereum is actually can be serving as a medium of exchange and a store of value, both of it, because it has unlimited supply that is deflationary, more deflationary than Bitcoin right now. And then also it's a store of value as well. And let's not just take this article's statement at its face value, right? Let's verify that. First of all, let's look at Fidelity. Fidelity is only behind Vanguard and BlackRock as the third largest asset manager in the world. And they are one of the few that actually are staking the ETH or getting ready to stake the ETH, as well as regulations is about to be rolled out. And they're actually mining their own, or rather, they're validators, and they're having their own staking their own Ethereum, actually. So what we want to understand here, community, is that let's look at some things that are very important. There are two key things that are driving economies right now globally. And those two asset classes are the most liquid assets in the world. First is the foreign exchange market. Forex market is extremely liquid. And that's what's used, among others, as reserve currencies as well globally. And if you look at where that takes place, that's on chain, that's stable coins. So if you look at stable coins, community, and you look at where are the majority, by now, of course, we know majority of stable coins are traded on Ethereum. And like we started this session earlier, we see that Ethereum, stable coins are literally have doubled transaction volume of Visa in Q1 alone. So stable coins that are merely 7 to 8 years old have the double of the transaction volume of Visa that has been around for 50 years and is well established on a global scale. This just shows you the potential that is yet to come. So if you look at foreign exchange, which is on chain, is known as stable coins, that more than half, 60%, are already being traded on Ethereum. And yet there are many, many more institutions that are already getting ready to launch their own stable coins, and companies as well. We already had Amazon and Walmart are getting ready to launch their own. We already had that Meta, former Facebook, are lining up, putting their heads together, trying to roll out their own. Banks are getting ready to roll out their own stable coins as well. So many, many more to be launched. So this will push this number even further. So the more transactions that are happening, that means more transactions are getting ready to take place on Ethereum. This is the first large asset class. Another large asset class is known as the bond market. And the bond market on chain is known as tokenized treasuries. Right now, tokenized treasuries are predominantly also on Ethereum. So we have the two largest and most liquid asset classes: foreign exchange, which is on-chain known as stablecoin, and the bond market on-chain known as tokenized treasuries, are both on Ethereum already. And this will bring demand for the bond market even more. It will spread the use and utility for the dollar, digital dollar, which is stablecoins, US denominated stablecoins, even more. And this will naturally bring down the interest rates for the bonds and make access to liquidity, to money, cheaper without the Feds having to intervene. Do we now understand why we question, why is the market acting so irrational? If the market would understand what we just discussed for the last few minutes, it won't be red like this. It won't be volatile like this. Actually, if the markets would be rational and look at the whole picture, it should actually be pumping, understanding that we are at the new era. We reached at the new stage where it's no longer required to do QE or quantitative easing by causing inflation. The new era is here. And the new era is the era of the blockchain technology. Now the government understands that, the Feds understand that we can use this blockchain technology, to be specific, stable coins and tokenized bonds, to naturally bring down the bonds' interest rates, lowering access to liquidity naturally without having to intervene by causing inflation, increasing the debt ceiling even more, and losing purchasing power. Now we can use these tokenized treasury bills to be purchased by these stablecoin issuers. And this will naturally bring down the interest rate. The Feds don't even have to intervene. The bill has already been passed, the Genius bill. So it's just a matter of days, weeks, months for these institutions to start rolling out their stable coins. And this will bring demand for bond markets. And this will bring demand for bonds to be purchased. Once that takes place, bond and interest rates will naturally come down on its own, strictly by this mechanism and this activity is taking place on chain, on the blockchain, specifically on Ethereum. So why is the market acting so irrational? It's because knowledge. If the market would understand that the governments, the world actually has embraced a new QE way to a new way to do quantitative easing. Once the world understands that the US has finally embraced a new way to do quantitative easing, and all that is taking place right now is just a theater in front of us. Trump pushing Jerome Powell publicly on social media, and him just ignoring that altogether and sticking to his guts because he understands that the Feds have two things that they need to mandates that they have to take care of. First of all, keep employment as high as possible, right? As low as unemployment as low as possible. So full employment is their mandate, and the second one is to strengthen the dollar. And by lowering interest rates and causing inflation and raising debt ceiling even more, that's not how you protect the dollar, especially with asset classes, all of them, the commodities market, the bond market, the cryptocurrency, the stock market are all at all-time highs. So why would he have to rush and cut interest rates if just this week Genius Bill was passed and institutions are lining up to launch their own stable coins that will naturally cause demand for the bond market. And once the bond market faces demand, it will naturally lower down or bring down the interest rates naturally through blockchain activity, specifically on Ethereum, like we just saw, right? Stable coins are predominantly on Ethereum. So volume on Ethereum is getting ready to skyrocket. And stablecoin activities are about to take place and skyrocket as well. And as we see, stablecoins already are doubling that volume of Visa. Secondly, we see how the bond market, also 75% of that tokenized bonds are already on Ethereum, but that demand is getting ready to skyrocket even more, bringing even more transaction volume on Ethereum. What happens if there's a lot of volume on Ethereum? Ethereum becomes even more deflationary. Transaction fees, more transaction fees for the stakers. And it brings demand, it attracts even more traders, more developers, more retailers to be even more active and deploy even more smart contracts on Ethereum. So it's a flywheel effect. And how does that affect us as an industry, as a community, as an ecosystem? Is that because we have 4 challenges that we're addressing, which is lack of liquidity, inflation, unsustainable staking distributions, and also inefficient use of volume. We are addressing all these 4 challenges. So this will put us on the top of the list to make the most out of this new way of quantitative easing, of actually bringing down interest rate using the blockchain technology without the interference of the feds. And this is a first time in the financial history that this is happening. And this is, it makes, you might think that Jerome Powell is not doing the right thing, but he's actually understanding that he doesn't have to do nothing but just be patient and let the blockchain technology, let the volume on Ethereum through stablecoin creation, issuers, and that will bring demand for the bonds, tokenized bonds on chain. It will naturally bring down interest rates without him having to interfere and actually cause even more inflation and cause loss of purchasing power and raise the debt ceiling even more. Once people understand this concept, they will understand that the US is literally becoming the #1 capital of crypto, and they're already dominating in terms of payment systems in US dollar, right? So the dollar is on chain, the dollar is dominating already. And then also tokenized bonds in terms of the bond market, it's also the US dollar denominated bonds that are dominating. So they're far ahead of everyone. So all these things that we're seeing going back and forth between Trump and Jerome Powell is just circus. But they already know what they're doing. So it's just a matter of time once stablecoins are starting to be issued by large institutions, specifically banks and these tech companies, will realize how naturally the interest rates are going to fall even further. So why is the market acting irrational? Is because of knowledge, right? Knowledge. If they would understand what's happening right now, the market actually is supposed to be pumping and not dumping right now. That's the message for today, community. I hope the message came across well. We always encourage the community to think critical. Let's just not go with the flow. Let's not just be blown along with the wind, but let's stand firm, understand, try to understand things. Let's challenge ourselves. Let's understand something. Let's ask why and understand it. Once we do, it will make sense to us, or it won't make sense to us, and we won't be swayed by emotions and sentiments like the markets are right now, very emotional and sentiment driven. But rather, once we understand what's happening and what's getting ready to take place and why Jerome Powell is standing on his decision, we'll understand why. right? So great things are coming ahead of us, community. Let's stand firm. Let's be prepared. Let's keep pushing and doing what we need to do. Bring awareness to the industry. Bring awareness to our ecosystem. That's it for today, community. Till we meet again. Bye-bye, community.